welcome, Andrew, back to the Options Tribe.
Thank you very much. Glad to be here.
Good. And I'd like to point out to everybody that Andrew was in New York a couple of weeks ago. Was it last week, Andrew, or the week before?
Yeah, last time
week.
flies, but yeah, just
That's
last
right.
week.
Time flies when you're having fun. And as a result of that, Andrew taped in front of a live Options Tribe audience. This is the first time we've done this, and I thought it was pretty cool. We had, I guess, 8 to 10 people from the New York, it's a tri-state area, Connecticut, New York, New Jersey. I don't think anyone was from any farther than that. These are active Options Tribe.
We had a Canadian visitor, actually.
A Canadian visitor. All right, that's great. And very cosmopolitan group attended, asked fantastic questions, and I think it really worked out great. And I know everyone on the Options Tribe is looking forward to the series coming out. I thought it was a really good group that we gathered, and if anyone wants to do that in the future, it was really fun, getting everybody together. So just let us know next time we're taping something, and we'll put out an invitation, see if we can fit. The big problem is going to be fitting everyone into the studio if we get a big enough crowd, but we'll see about that. So getting a comment. This was someone. Oh, yeah. Chris is saying he was sad not to be there. Chris was originally signed up but could not make it. So with that, I am going to turn the floor over to Andrew, who's going to be doing a presentation on this subject. Andrew, here we go. That's great. While Andrew's taking control, I just want to point out to anyone who's not been here before that Options Tribe is an open forum. There's a question section on your screen, and I would like you to please note that you can ask questions at any time. I'm watching the chat, and therefore, if you ask questions, I'm going to pick up on it. And if it's the kind of thing that needs to be dealt with, I'll ask Andrew to please answer the questions. So fire away.
All right. I'll just ask real quick, make sure if my sound is too loud or too soft. People can chat that in. I'll try to make the appropriate adjustment. And also ask if you see a full screen PowerPoint of a road, if that's what you're seeing right now.
John Dory said just right, and we're getting a lot of yeses, so it's a good sign. Yes.
Okay.
Yeses. Great. Thank you.
All right. So I've presented several times on linear regression and credit spreads. Most of the time it was a lot of information about the signals and how they're calculated and what the statistics are of the underlying market, and my screen just flashed, but let me know if something went away. I think it's back to normal. But so a lot of description on the underlying signals, market analysis, the cycles, the contrarian nature, and a little bit of discussion about what the options around that would be. So a lot of people said, most of the follow-up questions I get are they want the indicator, which I send out for free, and different ways, different questions about the options. And so what I decided to do was I've done a lot of back testing on the signals and a lot of back testing on the options. So what I did is I just picked a very specific set of parameters and ran a extended back test of every signal of the linear regression channel. And I have the results of the back test, and I'm going to try very hard to stay away from the theory and the underlying market information and really get into what are the expectations of these signals, and also really a big focus on the realities of the signals, which is sometimes difficult. So I never want to just paint the rosy picture and say this is a foolproof strategy, because nothing is. So this strategy has its risks, and I'm going to show you those very clearly, and also show you kind of what the long-term expectations are if you can control your risks in the process, and what you can, if the past is an indicator of any type of future expectations. I know the standard saying is no, you cannot expect that. However, that is what a lot of people base all of their decisions on. And the best way to do that is to have enough information, enough data points that you can feel comfortable with the decision that you're making. So I'm hoping I am producing enough data points here to give people a good sense of the expectations of this style of trading. Let's see. All right. So this is our new disclaimer. I think this is the first week that it's being presented. So I'll just quickly go through it as we leave it on the screen for a minute, but SMB is not a broker-dealer. This is for educational purposes only, and all trades are hypothetical and simulated. And as Seth discussed, that means your execution and commissions and slippage may vary depending on your ability and your quality of execution in the market. So, quick overview of what the signals are. The linear regression channel, so LRC means linear regression curve, is a statistical tool with actually more than 4 decades of results that have been consistently effective during many different market conditions. LRC channel trading is a mathematical way to buy relatively low and sell and short relatively high while respecting the overall trend. So there's a big emphasis on this is not just contrarian or counter trend. There is a trend component to it, but we are looking for short-term extremes and divergences in the market to actually take entries. Basics on signal statistics and how they were formed. There's a little bit of background noise. Okay, it went away. Hundreds of thousands of algorithm backtests on all 4 of the major indexes, the S&P 500, the NASDAQ, the Russell 2000, and the Dow, have revealed very consistent results using buying and selling points of 1.5 ATRs above and below the linear regression curve, with the ATR lookback and the linear regression lookback both at 20 days. Mm-hmm. And that's just, I'm just going to state it. I don't want to get too much, like I said, I'm not going to get too much into looking back on the signals, but that is the consistent results parameters. In the last 40 years, 1973 all the way to January of this year, there have been 702 signals on the indicator on the daily chart. The average time in all trades is 21 days, so that kind of represents the market cycle from when we're relatively high to when we're relatively low. It typically takes 21 days. The average time in the winning trades is shorter, which means if you're selling high, you do want the market to go down in short order after that. Mm-hmm. So the best signals happen quickly. We don't know that they're going to be winning signals or that they're going to happen quickly, but when they do show up, they're typically a shorter holding period, and the average time in a losing signal is 28 days, which means you've sold when the market was up, and it probably went up for a longer period of time before it corrected later, and that probably would be, the correction would happen at a higher price, mm-hmm. Thereby giving you a losing signal. And like I said, losing signals are caused by extended cycles. There are, the last 40 years, 63% winning and 37% losing. I know a lot of people try to find every bit of parameters they can and try to get up to 80 and 90 and 97% success rate. But I can tell you with the way I trade, very conservatively, if these numbers, if it was 55% winning, I would still be trading the strategy because it's good, consistent results, and I can use the options to improve those results.
So everything you're going over here, Andrew, is it fair to say is related to the cash market? In other words, all of these, yes. And it maybe, I'm not sure everyone understands completely what I mean by the cash market. Maybe you can explain that.
Yeah, the SPX is the index. It is a calculation of the 500 stocks in the S&P 500. You cannot buy the SPX or short it. All it is a calculation that the options derivatives are based on. Mm-hmm. So we are looking at the chart of the SPX to make entry and exit order parameters for the options market. So that's why we look at the signals, we look at the chart to see what the broad market is, and then we can make assumptions about what the options market will be doing, and that's the point of this options backtest, is to prove that as well.
And so when you say the P&L of an average signal, that's kind of notional, right? In other words,
yes,
because you can't
correct.
buy the SPX itself.
Yeah. So
right.
There might be a better term than P&L. I know it makes sense for people.
Right.
So because you could go and buy, if you had a fast enough computer and had no commissions, you could go buy the 500 stocks or short the 500 stocks on each signal and theoretically generate the same P&L.
Right.
So it's really, yes, it is the underlying. It is just a line we can draw on the chart that gives us a specific edge in our derivatives trading.
Okay. Now, Carl Steinbrecher is asking, has there been a trend towards less signals per year?
I've not seen that. I can check that I would just have to see that. I've not seen that. So I have to go see the best way to look at that, kind of block out each year, but I've not seen anything like that. It doesn't mean it's not there, but I just haven't seen it.
And Ethan Ho is asking, are you using the closing price of the signal bar?
No, this is whenever price has hit 1.5 ATRs above or below, that is the official entry. I have tested waiting for the end of day, and the results are extremely similar because there's usually not too much variation by the end of the day on most days. So it's slightly better on the long side. So when the market's dropping, it's slightly better to wait for the close by a fraction. So I wouldn't say it's even worth changing the strategy, but it's slightly less effective to wait for the close on the short signals. But basically, it doesn't matter which one you pick, but the one that's slightly better is just taking them at the official entry, 1.5 ATRs.
All right, and Chris Karpenko is asking, please define ATR.
ATR, I'm going to scroll through my PowerPoint to see, oops, I don't want to scroll that part of it over here. Let's see if we have that. No. I've done that in other presentations, so I'll give a very short version of it here. ATR is average true range, which is a calculation of, there's 3 ways it can be calculated, and it's the biggest number of these 3, but it's the low to the high, or the previous close to the current low, or the previous close to the current low. So it's whichever of those is greater, so it just gives you an idea of the total range of the bar, and so this is an average of that dollar amount looking back for the last 20 days. But any platform can give you an average true range indicator, and the indicator is given. I can provide that for people that want it. All right. So
I think that Chris said thank you, so it sounds like you're satisfied. Yep.
Excellent. And so this next point here is the average signal, quote unquote, P&L is 0.5%, which again is a very small number. I'm not looking for a big number. I just want a slight edge to format my options trades, and I want that slight edge to be very consistent in the long term, and that's what this provides. Go back here. All right. And here is that, again, I'll put the quotations around it, the P&L curve, as if you could buy and short the SPX. This is the summation of the amount that you have an edge and the amount you did not have an edge, adding up all of those signals for the last 40 years. And it is not an extremely steep curve, but it is an extremely smooth curve. And that's, again, what I'm looking for, is that smooth, consistent market edge that comes from being, in the broad market, being slightly contrarian in the short term while following the overall trend wherever the market leads you. And I'm gonna skip through it. I'm gonna try not to, because I've covered that a lot in previous webinars, and people really want to see the trade. information. So that's what I'm going to get straight into.
John Dory just said, by the way, that that chart was a thing of beauty to behold, and I agree with him.
It took a lot of man hours and a lot of computer hours to come up with that, and I came up with better ones, but they were not practical. It's not something you could have traded or would expect to work in the future. So that's just one that's a nice, conservative, consistent result. So yes, I enjoy looking at it too.
We are sick pups, aren't we, traders,
yeah,
right?
exactly.
Most people like to look at a beautiful garden or a lovely landscape. Well, we could sit there all day and just look at a nice, smooth P&L chart. We'll be happy.
Exactly.
All right.
So here, now I'm moving into the trade. So there's two words. I have signal and trade. Signal is the SPX chart. Trade is the options. So here, now I'm getting into trade statistics, which I have never covered in a webinar. So this is all the brand new stuff. The underlying signals have 63% historical probability of reaching a quote-unquote profitable exit, meaning what the chart shows you, at the other side of the channel. Using positive theta credit spreads on all of those signals further increases the probabilities of trade probability anywhere from 69% to 80%. So if the signals are 63%, have a 63% accuracy, the options trades on the signals have, depending on your parameters, and I'll explain this, have 69 to 80% probability of profit when the chart shows you the exit. So that means 7% of the signals, or 6, that's terrible math, 6% of the signals at minimum that show you a loss on the chart are actually closed out at a profit in the options market because of time decay, because of the amount of time you're in the trade. So a small loss in a signal can still be a profit in the options trade. And that is, the lower percent is at the money. So if you sell a credit spread that is the short strike is the first strike closest to the market without being inside, meaning if it's a call, it's not at or below the market. So the first strike at or above the market price brings in the lower probability, and if you move that short strike out to a 25 delta, that's where your 80% probability comes in. And then that's just your probability. We'll go into which one's actually more profitable, though, in a minute. The majority of trades win, but many trades have a drawdown before exit. And the word many should be replaced with the word most. Most trades have the market go against the trade first and before the profit is presented. And I will show you some examples on the chart of how that happens. So the idea is this is not an entry that you don't have high accuracy of. Get a lot of. Is that your typing?
I'm sorry. Yeah, I was. What's happening? What happens is people chat.
Oh, okay.
And sometimes they're sort of mentioning something specific to me, and I don't really want to mention it to you, so I'm typing it in, but I now realize I have to mute myself. So go ahead.
Oh, I'm sorry. All right. So the majority of trades win, but the entry, when you go through it, it doesn't seem like, and it is not the case, that you have very, very efficient entries. And that is always the case with any strategy that is contrarian, where you're taking a position that is contrarian to the current momentum of the market. When you're a trend-following trader or a momentum-following trader, usually your trades go with you right away, but when you finally realize it's time to get out, you either have to give back some of your profits or actually find the loss later in the trade. So that's just something, a good point to make and understand in moving into the strategy, that you don't see high efficiency entries, but the trades, 69 to 80% of the trades end at a profit. So you have to fully understand the expectations of the trade cycles so that you can maintain your positions, especially during the difficult trades, the ones that go against you and you don't know what the exit's going to look like. Benefits of the trade. The trade requires almost no management between signals. So the signal cycle I told you about that has 21 days average, shorter for winning trades and longer for losing trades, that's most of the time, 80–90% of the time, you don't have to touch your platform for that entire period of time. So this is a very low frequency, low management, low commissions, low spread cost, all of the things associated with something that's not extremely active. That is the benefit. So if you don't like strategies that require you to watch your computer all day or make constant adjustments and then have to just take those adjustments back off frequently, this is the type of trade that you set it and forget it. However, you're going to see your P&L move a lot more than some strategies. So there's a trade-off. You don't have to manage it a lot. However, you may not like what you see during that period of time. But if you have a good expectation of what the trades typically look like through their cycle, then you can learn how to manage that.
Andrew, Mike K. has asked a question, which is, if there are so many drawdowns, why not scale into it?
Because there's a lot that don't. Mm-hmm. And I don't want to miss any of the trades. And another thing is, not a lot, but often enough, the day you get in is the last day for the move. So if you're not in that, what are you going to do? I don't know. You're going to miss the entry. You're going to take a worse entry. You're going to hope that it comes back again and gives you another chance. And the other one is, if it goes against you 1 or 2 days, 3 days, 4 days, that it goes against you, you have time on your side. By the time it crosses back over your entry point, you'll be at a profit because of time decay. So I don't mind getting in and letting my target price, letting theta work down there. And I would say down, like the last 3 months I keep saying down because that's all I've been waiting for the market to do during a lot of the cycles. But this last up cycle, we're on a long signal. This isn't, like I said, it's not a contrarian counter-trend strategy. It is a contrarian entry, but we respect the trend. So recently, most of the markets hit the bottom of the channel, and we've been in a long cycle. And the trades are doing just fine right now. So a lot of those signals, and I'm going to stick with the trades and not get too much into the chart, but yeah, they went against you for a day or two, but the day that the market gaps up, you're going to wish you had just taken the normal entry. So that's just a trade-off you're going to have to, there's always pain. If you try to leg in and you miss it, there's your pain. If you take the strict entry and it goes against you, there's your pain. There's always a trade-off for the strategy and the rules you pick. As long as you understand how you're going to manage that expectation, then you'll be comfortable.
Okay, we're getting lots of questions.
So let's hold off because we're halfway in, and I feel like I'm going to miss a lot of the very valuable information.
Okay,
so
great.
I'll answer every email that comes my way afterwards, but I can't show the good information via email afterwards. So we'll keep sending the questions in or start.
Great. I'll just keep track of where we've stopped,
yeah.
And we'll catch up with them later if we can.
Sounds good.
Great.
Another benefit, you do not have to watch the market intraday. As I said, the commissions and spread costs are low. The less you trade, the less commissions you spend. So that's something to always remember. No stop-outs or overreactions to noisy markets. The risk is defined in the spread. It's not uncovered positions. These are spread positions. We have defined our risk. That is how we control our losses, not by taking stop-outs or overreacting to market noise. And this is 100% rules-based. The criteria for entry, exit, managing your winners, and managing your losers. Obviously, there is always some type of discretion on getting your orders executed, but as far as strike selection, time to expiration, when to enter, when to switch directions, there is no guesswork in the rules, in the back test. So I show you the back test. There's no hindsight at all. It's the strict signals, one set of rules for the entire 8-year period of time that the back test covers. And here it is, 8-year back test review. Last 8 years, January 2005 through January of this year, there was 136 signals. I also call them cycles sometimes. This includes the financial boom, the financial crisis, the Great Recession, the 2009-2010 recovery, which in my understanding of how options work, the recoveries can actually be worse because you get more than 100% gains, and the options skew in the market can go against you if you sell near the money calls. It's just as bad as a crash. So a lot of people don't realize that the market going up rapidly is just as detrimental as the crash is. And the flash crash is included, QE 1, 2, and 3. So every type of market cycle and market manipulation you can ever think of that can happen has happened during this 8-year period of the backtest, etc. So anything else you can think of during that time that makes this a good long-term period of time to do a backtest, versus if you did an 8-year backtest from the early 90s through the end of the 90s. That was primarily bullish market conditions from the end of the recession in the early 90s through the tech boom. So that would not be a period of time that shows you two-sided markets and multiple types of markets. But this last 8 years is a good example. And here is the chart of the SPX, so the S&P 500, during the 8-year period of time, and you can see that that slow drifting bull market ending with kind of a more rapid bull market, a sideways top, a moderate decline followed by a sharp decline, followed by a sharp rise, and some sideways markets and some corrections. So just about it's just one of those classic market cycle charts that you want to see drawn. Here is the P&L, and this does include commissions for the options strategies, so the options signals on the linear regression channel. The green line is the 25 delta. So that's that out of the money spread with the higher probability of profit. So that's the one that has 80% probability of profit, is the one that's less profitable because your credits are smaller. The top one that only has 69% probability of profit, each credit is so much larger that when you have a good signal, those wins far surpass the inaccurate or the difference in accuracy over the 25 delta positions. So this last backtest, so you'll see other presentations I've done where I talked more about out of the money for the probabilities. The more and more I test, and I've done thousands of these tests by hand, I'm getting closer and closer to the money in my trading and in my development of other signals. So that's something that might be new for people that have been following this type of strategy, is near the market seems to be better. There are more losers, but the winners far surpass that. So I'm going to go through a few trades. I'm not going to show you all of the trades because there's not enough time, but I'm going to show you, and I'm going to start with these because you can't define your expectations unless you understand the downside, and that's true with any type of investment. So I'm going to show you the downside first, and I wanted to show you really bad downside because it can happen. So if you can define what portion of your account you're willing to allow this to happen, then you can start looking at what you're willing to look at for returns. But you always have to define risk first so that you can define your expectations and not have a bad surprise. We don't mind good surprises, but you don't want to have yourself set up for a bad surprise. So start with two big losing signals that the trades lose a lot. And in statistics, that would be called a fat tail in the probability cone or a bell curve. I'll show you two difficult trades that win. So this is that idea of you have early entry, the market goes against you, and then because you have patience, endurance, and you let theta work for you, the trade actually works out. And then I'll show you one medium-sized win that kind of had a little bit of the market go against you, and then I'll show you one big win where you just absolutely grab the best price and it runs directly in your favor. And so that heat term, that's what I call when the market goes against you. Like I say, that's when you're taking heat.
Mm-hmm.
All right. So this is we're going to do the 2 losing trades first. So the first losing one is December 2007, and it is a long entry. The underlying signal, so that means what the chart did, was your entry and exit are 6.61% apart from each other. The time in the trade is 39 days. So remember we discussed that the losing signals have longer. So the losing signals have an average of 28 days in the trade. This one's so bad it actually was 39 days. It was a very long cycle.
Mm-hmm.
We used a $20,000 max loss, so the spread could lose $20,000, and the actual loss taken on the exit was $13,000. Here's a chart. Here's your entry. This is your exit all the way down here. And as you can see, there was a nice recovery. So it is a losing signal, but there was a point in time where it was losing a lot more. But the market comes back and shows you an exit up near the top of the channel. And that is just what the chart looks like. I'm not going to go into the P&L profiles of the options or the exact spread widths or day's entry and everything. All of that information is covered in the course. So we're going to save some of that value, mostly because it just takes a lot of time and there's a lot of details that need to be discussed. So that's all in the course. But this is the concept of an at-the-money put spread taken at the bottom of the channel, waiting for the top of the channel, where this is an example of where that does not work, and it does not work in a very bad way. Here's a January. I was looking at the 1. September 1st, short entry that does not work. The underlying signal loses 5.5%. It is a 22-day losing signal, so actually in the lower end of a losing signal. And the options trade defined risk was 20,000. The actual loss taken was 6,000. Here's the chart, and you can see that was kind of selling in the hole. We did wait for kind of a relatively good entry in the channel. However, the market immediately ran up quite sharply. That's your exit on a pullback up higher. And as you can see, here's where the respecting the trend works. We buy the pullback. And then your next trade, which I don't show you, it's not included in this, I'm just showing you the loser, but I wanted to show you on the chart that switching directions, when the strategy says to switch directions, hindsight you say, yeah, well, clearly it was an uptrend. But looking back in the chart, a lot of people were probably expecting the market to maybe retest the lows. However, taking that entry strictly and getting into that position would be one of those times you would not want to be legging in. You would want to take that signal as it's handed to you and hold for the duration of the trade, which would be a very large win. Oh, yeah. Okay, so here, and that was the 2 big losers. I know the first one was I think the biggest loss in the last 8 years. The second one was probably in the middle, or you know, second, probably third or fourth as far as the largest losses. So, but I wanted to include a long and a short. So that's what those were to show you. Here are 2 drawdowns that ultimately are exited for a profit. We have a long and a short. First one is a long entry, and here's the interesting thing. This is a long entry in September of 2008. So right as the financial crisis was taking hold. We have a long entry that has the underlying signal basically breaks even. So 15 days goes by, and the drawdown during the cycle, the market went 9% against you before it turned back to the other side of the channel. The options trade, $20,000 risk, this one's exited for a profit by waiting for strength to close the long position. Here's what the chart looks like. Here's your long entry. So this would be a counter trend position, all counter trend and contrarian. So short term drop in a long term trend. Your exit is over here. However, the market came from all the way down here. So you get long on this day, and you immediately see the market go and take out this low and sharply drop from there, 9% against your position, only to see a massive rally back to the top of the channel, and then look at the efficiency of that entry. The market barely breaks through the channel, giving you an opportunity to exit this long, put on a short, and take that one to the other side of the channel. So that's just an example of one that a little bit emotional maybe, a little difficult to hold the position, but on strict entry and exit, no hindsight, just following the rules, turned out to be quite good. And that's the next trade. Here's the short entry, the underlying signal, again, about break even, but slightly profitable. A 19-day, so again, a profitable trade is a shorter cycle. The drawdown during your signal, the market goes a little over 3% against you, and the options trade is $1,800 profit on a $20,000 max risk. Here's your chart. This is the short. That's your exit, and this is the path it took before your exit. So again, these last two examples are where it's difficult, but it ends well. The first two were difficult, ending very badly. These two were difficult, ending well. And now I'm going to get into what we're actually doing this for, what we're looking for in most of the trades. But I wanted to spend a good amount of time showing you the downside and the difficulties. And then this is what we're actually looking for more of the time. The first is a long entry that has a medium-sized win and the market only goes against you a little bit. And the next is a short that is a big win and the market doesn't go against you at all. Long entry, the underlying signal is 1.26%. And you start to see how we have that average of 0.5. You get a lot of trades that are about a 1% win. And then you get a handful of those really bad ones, and that's what kind of pulls that average in to 0.5. But your winners seem to be right around that 1% level. 12-day cycle. So another example of a winning cycle is quick. Signal drawdown before exit, just 2% against you. The options trade P&L, $4,000 on $20,000 total risk. Here's your long entry. You can see the market drops against you for a couple more days. That's your exit. We'll go back to that. So relatively short, a couple of days against you. The top of the channel comes in. So you can see here, when you got in, the top of the channel was way up here. So that's the ideal scenario, which does not happen all the time. You're expecting the channel to kind of drift one way or the other. It drifts down, the market comes back up to the channel, and you take your exit, at which time you would reverse to a short. It might go against you a little bit, and then you take your long back down here for looks like a tiny profit plus some time decay, so another winning trade there. Here's your short. The underlying signal is about 4%, so this is that big win that we like to see every once in a while. A 6-day cycle. So this is a very, very short big win where the channel has its full width in your favor during the time of the trade. The signal drawdown before exit, 0.01%. So I call that nothing. You may have seen a few dollar ticks against you, and then the next day it's going right in your favor. And the options trade P&L is $8,500 on a $20,000 total position. And that is right here. So the market has kind of begun, it definitely has begun a kind of a downtrend where you start to see lower lows. we take a rally back up to the top of the channel, and you would reverse positions and have a very nice decline from there. And I always like to look at the next trade. And the next trade is a little bit of heat and probably break-even signal with a small win based on the time that it took to get to that exit.